Hello and welcome back to Pacific Business Brokers video blog. I'm Amanda Reale. Today I'd like to talk about due diligence. What is this due diligence and really what to expect? When buying a business, due diligence refers to the process of reviewing all of the available information related to that business. Due diligence means digging deeper with the goal to make sure that all financial, legal, and operational issues pertaining to the business are in order and that there are no unpleasant surprises should you decide to go through with the purchase. Due diligence is a process of verification whereby the purchaser has a chance to verify everything that has been presented and confirm that what he or she is getting is true and accurate. Depending on the size of the transaction, due diligence can be an exhaustive investigation of matters and facts, or in the case of a small business, it is often much less onerous. In large transactions, a due diligence process can include multiple teams of accountants, lawyers, and special matter consultants or advisors, while on smaller transactions, it is typical for the purchaser's accountant to work through the financial aspect while the lawyer handles the legal portion and often the owner performs the operational part. So why is it so important? Well, from a buyer side, it's important that the buyer feels comfortable that his or her expectations of the proposed transaction are correct. Purchasing a business without such due diligence would in most cases substantially increase risk to the purchaser. From the seller's perspective, it's important that you be aware of what this due diligence entails, since surprises to buyers often collapse a transaction due to a sudden loss of trust. A seller would be well served by preparing for due diligence ahead of time. In fact, here at Pacific Business Brokers, we perform our own broker due diligence in preparation for a potential buyer performing his or hers. Due diligence in smaller transactions can take as little as a couple of weeks, while on larger transactions, it's not uncommon for due diligence to take several months or longer. In some transactions, due diligence will carry on right through to the closing. Typical due diligence is divided into three major sectors: operational, financial, and legal. An exhaustive due diligence list might contain hundreds of items, but in this short time space, a non-exhaustive sampling of a typical due diligence schedule would contain the following. I'll try to break them up into three major sectors. Number 1, financial. Ask for the company's audited financial statements. Request balance sheets, income and cash flow statements, as well as business tax returns for the past 3 to 5 years. Include future projections or budgets. Request additional tax information, provincial and federal tax positions, warranties and other financial liabilities, anticipated expenditures with a capital or inventory swings, and details on working capital. You and your accountant should review them with the following in mind. AR and AP. Is the business collecting its accounts receivables and paying its debts in a timely manner? How much bad debt does the company write off each year? What is the profit margin? Number 2, legal. Ask for copies of any professional and consulting agreements, insurance policies, licenses and permits, any documents related to intellectual property, such as patents or trademarks, and any documents related to pending litigation. You and your lawyer should review them with the following in mind. Are the agreements enforceable? Does the company have the rights to its intellectual property? Is the business adequately insured? Are the company's licenses and permits current? Is the company involved in any litigation, and if so, what are the potential risks, costs, and damages? Number 3, operations. Ask for info on customer or supplier concentration, market share, technology, historical and projected growth rates, a list of machinery and equipment, and an operations manual. Review this information while considering, does the business have adequate inventory systems in place? Is the company's supply chain diversified, not overly reliant on any one supplier? Is the company's customer base diversified and growing? Does the company have necessary equipment and infrastructure in place for continued growth? In addition, gather information on employees, such as organizational charts, employee handbooks, agreements of wage, salary, and benefits. Make sure you document the business structure. For example, if a corporation, ask for a copy of its corporate charter and bylaws, directors, and shareholders. Due diligence is a critical part of a sale or acquisition of a business. This is where deals often fall apart if not properly orchestrated and managed. At the end of the due diligence process, you should have a clear picture of where the business is today, where you can take it in the future, why the owner is selling, and whether the asking price is fair. Using the services of a professional and knowledgeable business broker or intermediary will ensure you, the vendor, will pass the due diligence with flying colors, while you, the purchaser, will feel much better about the investment you'll be making, knowing your due diligence was thorough. Thank you for joining me today on another aspect of business. I'm Amanda Reale.